We'll continue to sort of bring in various aspects, but let's get some perspective in. We have Adrian Mowat now joining in, someone who's seen global markets and global cycles for a long time. Adrian, great to have you with us here on the program. Thanks very much for your time. US recession, it's just sort of come up upon us. There is, of course, the yen, which is so much of the talking. I think about 70% of the print space is now being taken up by what's happening with the yen. So where are we at? Is this the start of something, or is this just like one of those knee jerks which we see and the market moves on?
It's more you used the word recession. We're starting to talk about the risk of a US recession. So why have we suddenly started talking about that? Well, I think there's been two data points. One has been a weak PMI, both in the US and globally, and the other one was the labor market data. So you've got job growth at 117,000, but people are increasingly highlighting that some of the seasonal adjustment may not be correct, and perhaps the labor market's even weaker than that decline from expectation of 200,000 job growths a month down to 100,000. And maybe the momentum is being lost in this economy and the risk of a recession is rising. But remember, we're talking about the risk of a recession when the Fed has interest rates at 5.25%. That's the highest level we've seen for almost 2 decades. So the Fed has got an awful lot of firepower if they decide that they need to help the economy. And if the Fed is going to move and cut rates, and we're now looking at the possibility that rates are down by a full 1% this year, with perhaps 2 cuts of 50 basis points each in the next couple of meetings, then equity markets are going to start to look ahead and think, right, okay, well, things are slowing down at the moment, but the central bank is responding. And perhaps some of these cyclicals, some of these non-tech stocks that haven't done well year to date, many have actually fallen, perhaps begin to perform well as the Fed provides help to an economy if this economy is really slowing down.
Adrian, morning, afternoon, and thank you for joining in. So on the subject of Fed, there are some who are now saying that the Fed has waited too long to cut interest rates. Would you concur with that?
I think the Fed has looked at the data, and the data as of now has been a headline inflation rate well above their 2% and a job market that's looked pretty robust. Now, we do know that monetary policy acts with a lag, and the tightening didn't seem to have slowed this economy down at the rate you would have thought it would have, considering that the tightening started in 2022. Is the Fed a bit behind the curve? Maybe, but I'm not sure anyone else could have done much better.
Adrian, great to be listening into you. Yeah, take that point. I think it was somewhere in the middle of summer, May or June. That's when the data points started weakening on retail sales, consumer confidence, and we had the manufacturing PMI, which was quite bleak. And then finally, this jobs report. But to go back to that point, in terms of what happens from here on, you've seen this tape play out before in far sort of, I think, more difficult circumstances as well in the past. Now, if the Fed starts cutting ahead of the next meeting, and if they start delivering these bazooka cuts, say 50 basis points suddenly, will that help the market, or will that, in fact, spark further panic? What do you forecast for the next couple of weeks?
It's a cut at the September meeting that's not that far away. It may feel like a long time away, considering how quick markets reacting at the moment. And a cut in between meetings, no, I think that would be an incredibly negative signal to the market. It would suggest the Fed knows that things are much worse. I think it would be terrible for market confidence to get an intra-meeting cut. We've got a meeting in September. I think a decisive 50 basis point cut would be very appropriate and would help comfort markets.
Okay, great to get that view, because we had experts from Jefferies and JP Morgan earlier, and they said that maybe they'll cut even before September. So that's why we were wondering whether that will be actually, well received at all by the market, but you've made that clear. Just to go back to the point on Japan, so what's happening simultaneously is that you've got the US all set to cut, you've got Japan, hiking rates, the yen surging, and it seems to be compounding the whole carry trade situation. What have you made of what's happening there and the sort of the interlinkages between the markets?
So the yen had weakened to almost across 160 at one point. It was a good place to borrow. Rates are still zero, and the currency's been weakening. So we're seeing an unwind of that risk trade. Now, part of that unwind was through a catalyst from the central bank, with the Bank of Japan intervening. But I think it's all sort of worked well in terms of markets that were quite extended with the yen oversold, with US tech equities perhaps overbought. And you're just seeing an unwind of risk. And for the yen, I think it will probably overshoot, but then I think it will go back to being a relatively weak currency. I'm not a buyer that the Bank of Japan should be raising rates. I think domestic demand in Japan still remains very weak. I don't believe the Bank of Japan should take the risk of tightening policy at this point. So yen weakness, NASDAQ falling is about risk off. Probably has a bit further to run, but I see this as more a correction in what is still an uptrend in equity markets, and probably still a story of a relatively weak yen.
Right. Got that. So I have a couple of questions on this, Adrian. One, is this actually, there's no way to know, right? Anecdotally we get, when we speak with a lot of market participants, there is unwinding, etc. Do we have a sense of how large this carry is, the carry trade is?
We don't have any data on that. And, often, people don't need to publish what their positions are, particularly in markets like currency markets, where it's very much counterparty to counterparty. The price action will tell us where we are in the unwind. Unfortunately, there isn't any other evidence we can look at.
Okay, so let's say the interest rate is 0.25% in Japan, 5.5% in the US. Say the US gets to a recession. The expectation was that interest rates will fall by about 125 basis points this year. They'll cut by 125 in 2024. And some are saying that the terminal rate, which was supposed to be 3% or slightly above, if this is a recession, it can actually go even lower. The point is, has this rate differential come down enough for the yen to be for the yen to stabilize and stop being such a factor?
So, look, I think there are a couple of things we're talking about here. So, the central bank of the United States cares about the United States, and we can have a debate about what neutral policy is in the US, but I suspect it's somewhere between 2 to 3%. So if the Fed's concern moves to growth and employment, then we should expect the Fed to be cutting rates quite aggressively to move to at least neutral. And perhaps if the economy does go into recession, then they will move below neutral interest rates. That would still give you a positive interest rate differential in favor of the dollar versus the yen. And I think what people will look at with regards to the yen is the robustness of domestic consumption, job creation in Japan, and not be fooled by an inflation rate that's positive primarily due to imported inflation rather than excess demand in the Japanese economy relative to its ability to supply that demand.
Absolutely. Point taken, Adrian. But, not 5% interest rate differential, right? 20 yen, USD JPY falling 20 yen with a 5% interest rate differential is massive, which is essentially what we've had. I think we've had that once in the last 20 years. I think the last one was 98, 99. A great chat as always, Adrian. Appreciate you joining us, and thank you very much.
I think with the
Sorry,
yen,
you want to come in?
I think with the yen, remember, that they've basically been at zero interest rates, and the Fed has been moving its interest rates. So,
absolutely.
Thank you.
Thank you very much, Adrian. Great chat. Appreciate you joining in and good conversation. 630 points lower is what we have on the Nifty. We're at about 24,100.